Okay, so fine. Let's start this session. This is Raghunath from niftybanknifty.com. First of all, thank you so much for joining us on Hangouts Live today. Today is a very auspicious day, 14th April. It's Tamil New Year here, and glad to interact with you guys. So the idea of this initiative is to basically help retail traders earn a passive income through option trading. So what we believe is that we have to focus on few strategies, maybe one strategy at a time, and perform a very few trades, maybe one or two trades a week, and earn consistently 1% on the invested capital per week. So that is the basis on which we have started this initiative. So, in the interest of time, I'll quickly jump into the contents of this online workshop. So, I'll take you through the site, about myself, and some basics around, say, options like components, different payoff diagrams, what and how to use standard deviations for predicting uh, the index movements, open interest, put call ratio, max pain, and so on. And after this, I'll actually take you through the different tools that we have built in our website, and post which some information around the performance, and then next workshop that we are planning to conduct in near future, and further details basically. So yeah, so basically I'm from Madurai, Tamil Nadu. I'm an engineer from College of Engineering Gindi, Chennai, and I did my MBA in finance from IIM Ahmedabad. So I've been working as data scientist across Myntra, Axis Bank, and right now in a startup. So throughout my 8 years into trading, I have actually tried developing a lot of strategies, tested a lot of option strategies over 4 years, and close to somewhere in the beginning of the previous year, I started actively investing and trading in options. So I participated in Zerodha challenge and I won it several times. So let me take you through the website. Yeah. So this is our website, niftybanknifty.com. And here you have a tab which has several, what do you call, information. So this is research bit. Say our entire analysis is basis 19 years historical data. So we have taken the expected movement of the index over the past 19 years, and we have used this to compute standard deviations and other key parameters used for option selling. And there is also another page called coming soon, and we have actually added some alerts based features, something around optimizing the expected profit given a particular risk, and so on. So a lot of interesting stuff is being designed by our team actually. So you can go through this website whenever you find time. And I'll come to the tools here at the later stage of the workshop. So we have a Q&A forum wherein you can ask questions, and say you can answer, and other experts who are using this website can answer actually. So there's a lot of information here in our website. And yeah, so let me get into options basics basically. So before this, I would like to talk about different terms that we use here. The first one is underlying instrument. So this can be an index like say Nifty IT, Nifty Bank Nifty, or it can be any stock, say State Bank of India, HDFC Bank, and so on. So it is underlying instrument. Basis this underlying instrument, you have these metrics like spot value. So what is the current spot value of Bank Nifty? It's 29,939. And basis the spot value of the underlying instrument, we have derivatives, and one of the derivative is option and the other one is futures. This workshop will limit only to options. And for options, there are multiple parameters like strike price, option premium, and there are two types of options called call option and put option. And options are linked with options and futures, they're linked with expiry date. I hope you know the basics of options. So let me get into the other aspects. So options, basically the premium consists of two components. One is the intrinsic value and the other one is extrinsic value. So intrinsic value is basically the real value of an option at expiry. So let's say Bank Nifty is trading at 30,000. So 29,900 call will be at 100 rupees, which is the intrinsic value. Extrinsic value is always linked with hype, whether the underlying index will move ahead or move up or move down. So let's say we have 4 days to expiry. Then this extrinsic value as a function of time value and implied volatility maybe, let's say, 120 rupees basically. So now the option premium will be 100 rupees, which is the intrinsic value, and the extrinsic value is a function of time value and implied volatility. Let's say 120 rupees. The total will be 220 rupees actually. So this is how option premiums are calculated. There are complex functions that determine the option premium. One is the Black-Scholes model. It's very complex, and we'll not cover this in this workshop. So throughout this workshop, I'll be using something called as payoff graphs, and just a small explanation about it. So the x-axis is basically strike price. So it will denote the point where the underlying instrument will end at expiry, and the y-axis basically denotes the profit. So it can be, so anything above this x-axis is profit, and anything below the x-axis is loss. So quickly getting to different payoff diagrams. So when you buy a call option, the payoff diagram is like this. So the call buyers would expect the market to move up basically. So let's say this is the strike price, and beyond this point, option buyers start making money. And the same case in case of put buy. So the option buyers would expect the markets to crash basically, and they would gain when the market goes down basically. So the pair of buy call and put buy, they are horizontally. You can flip it basically. You can flip it and get the image. And the same applies to sell call and sell put. So the call writers would expect the markets to go down basically. So when the markets go down, they benefit the most actually. And one difference between buying an option and selling an option is that when you buy an option, the loss is limited and the profit is unlimited. Say in both buy call and buy put, you have limited loss and unlimited profits. But in case of sell call and sell put, you have limited profit and you have unlimited loss, as you can see here. So getting on to complex option strategies. So we'll limit to option selling in this workshop. So here you have sell call, and let's say the premium is A rupees, and you have sell put, and the premium is B rupees. When you do both these, option strategies together, you get something like this. The payoff diagram becomes something like a trapezium with unlimited loss on both sides. So this strategy is called short strangle. Can be noted that the premium here is A rupees and here is B rupees, and the max profit that you get is A plus B. So there are different types of shorting positions. So the ones that we use here in this workshop, they are short straddle and short strangle. So when you write both call and put of the same strike price, it's called as short straddle, and you can see it here. And it gives maximum profit basically. The point here is maximum for short straddle. And when you go for say different combinations of strike price, you may get something like a trapezium, which is called short strangle. And yeah, so if you move further down, you have something like a short strangle position, but with very low premium that you can collect here. Yeah. So I hope you are following, and if you have any questions, please do ping on the WhatsApp group. So I don't think like the chat facility is enabled actually. So if you have any questions, please do ping on the WhatsApp group. So I'll give 10-second pause to take questions, beyond which I'll start the next few slides. I'll go to the next few slides. Okay, fine. I'll go to the next few slides. So standard deviation is one of the most used concept across, say, there are a lot of sectors which use the concept of standard deviation, be it actuaries, be it pharma, be it say banking sector. So wherever you find analytics today, you have some kind of tool or say technique that uses standard deviations. So standard deviations basically show the expected movement of some, say, index or some price movement, or say particular distribution of a particular set over time. And so what you see here is a distribution of say some very random variable across different samples, and can be seen that the sum of the entire standard deviation curve is 100 percentage, and you see that it is centered around a mean point, and you have standard deviation minus 1 sigma here, standard deviation plus 1 sigma here, and so on. Now let's see how we can use this for identifying the expected movement of say Bank Nifty index. So this is daily chart of Bank Nifty taken from Zerodha Kite. And so when you compute the mean movement, say from one day to other, so basically the closing price of the index, say today, divided by closing price of the index in the previous day, you get expected returns per day basically. So when you compute the expected returns over a longer period, and if you try plotting them in the form of a distribution, you'll get a standard deviation curve as seen here in this figure. So, I mean, if you compute standard deviations, you might get an expected range, something like this. So the range is narrower because one standard deviation would correspond to 68 percentage. So what it means is Bank Nifty will stay within maybe 300 point range up and 300 point range below. So let's take today's example. Bank Nifty is at 30,000. So the expected range might be say 30,300 and 29,700 in next one day basically. So if you take two standard deviations, the range will be higher. And if you take three standard deviations, the range will be even higher. So if you see this table, you can see that one standard deviation is 68 percentage, which means with 68 percentage surety, you can say that Bank Nifty will fall between minus 300 to 300 point range from today's closing price. And in case of three standard deviations, it is 99.7 percentage, which means like let's say the three standard deviation values 700 point plus and 700 point minus. So which means given three standard deviation and the closing price is 30,000 today, Bank Nifty will close maybe at 30,000 within the range 29,300 and 30,000. So let's see how we can utilize this to write options. So before this, I'll like to explore, I mean, I'd like to take you through other concepts around open interest and put call ratio max paying two. So options are basically written by institutions and traders who have a lot of capital. So what happens is these big institutions and traders show interest in basically selling an option. So a trade is initiated when seller is actually planning to sell an option at a particular price. And what happens is if a buyer is actually interested to buy that particular option, a trade is executed. So you can see the open interest chart on NSE website. So you can see calls here on the left side and puts here on the right side. So what it means is, I mean, this column represents strike price, and this column represents last traded price, implied volatility, volume, open interest, and change in open interest from the previous day. So if you see here, 30,000 calls, open interest is 4,83,640, which means there are option writers who are trading at volumes 4.8 lakh and they are ready to sell options at a particular price listed here. And when a buyer is actually ready to buy that particular call option, the open interest reduces by 1 unit, I mean 40 units, because the lot size is 40 and the volume increases by 1. So that's how open interest and volume comes into picture. So you can see here from this chart that all say multiples of 500 have very high open interest. So because it's a psychological barrier, right? Like when Nifty or Bank Nifty crosses say 10,000 points, 9,000 points, there's a huge movement in the index, and that's why you can see a lot of option writers waiting at 30,000 levels, 30,500 levels. And similarly, input, you can see that there are writers waiting at 29,500 levels, 29,700, 29,800 levels. So these levels actually act as strong support and resistance, basically. So I'll explain you in the upcoming slides. So I think there is one question. Yeah, there is one question posted by Rajiv Cholan. Okay. Oh, he wants the link basically. Okay. So yeah. So I'm using the same option chain table here for further say slides. Let's take the same example. So PCR represents put call ratio, which is total put open interest divided by total call open interest. So basically, you will sum all these numbers, you get a particular value. You sum all these open interest numbers, you get a particular value. When you divide, say the total put OA and total, when you divide the total put OA by the total call OA, you get PCR value. PCR value currently is around zero point 0.7 for Bank Nifty, and if PCR value touches 1.3, it means underlying stocks, say maybe underlying stocks like HDFC Bank, ICICI Bank, State Bank of India, all these stocks are bought at very in large quantities. So there can be a bearish reversal anytime actually. So if PCR hits 1.3, 1.2 range, it's a good sign of bearish reversal. And that's the same case in terms of if PCR value crashes to say zero point 0.5, it means stocks are not bought and they're oversold basically. So there's a good chance that people pump in money into all the underlying stocks and they'll push the what do you call index upwards. So I'll move to Max Payne. So there is a constant struggle between, say, the call writers and put writers. Call writers will benefit when the markets crash, and put writers will benefit when the markets go up, basically. So let's consider this tug of war example. So this line here is the Max Payne line, and this particular black cloth is basically the spot value. So what happens is there's a constant, say, fight between the call writers and push writer and call writers and put writers, and a deviation of this particular spot value from the max pain is a clear indication that markets are moving in a particular direction. So what happens is, let's take different scenarios when Bank Nifty ends in a particular value. So let's say Bank Nifty ends at 31,400 on 18th April. So most of the call writers would lose money because Bank Nifty has more 1,400 points. So if you compute the total open interest volume, if you compute the total loss made by call writers, if the Bank Nifty moves to 31,400, it's approximately 300 crores actually. And in the other case, if Bank Nifty crashes to 28,400, the total loss made by the put writers, it's 300 crore. So you compute the loss made by both put writers and call writers across different strike prices, we'll find that there is one strike price where the loss made is minimum. So this point is called as max pain. So as of 12th April EOD, Bank Nifty ended at 29,939 and the max fine is 30,000. So there's a spot value always I mean, it will be closer to the max fine value. You can see here Nifty spot is at 11,643 and max fine is 11,600. If there is a drastic shift of max pain and the spot value, like the difference is huge, it's a clear indication that Bank Nifty will move towards, I mean, the spot value will move towards the max pain value. So you can use this as an indicator while hedging positions or rebalancing your option selling portfolio. So I'll take you through the demo of the different tools available on the website. So before this, if you have any questions, kindly ping on the WhatsApp group. I'll take the questions. I'll pause for maybe 10 seconds, and if there are no questions, I'll move ahead. So yeah, Ishwar has asked a question, which means where he says if PCR is greater than 1, there are more put writers when compared to call writers. So yeah, PCR has, I mean, there's a contrary opinion on the PCR metric as such. So they see it in a reverse way basically. So when the PCR is very high, it means that it is being bought in large quantities and hence it is a with good sign of bearish reversal, and the PCR value drops to say lower values like 0.5, 0.3, then it's a good sign of bullish reversal. So it is just viewed from a contrarian view, and it's not the actual say division of the call OA, I mean put OA and call OA. Okay, so only the current OI is used actually. Yeah. So again, there are different theories, different houses, and each one have their own definition. So since the volume across say other expiries, which is say end of April, maybe 25th April or say first week of May, the volumes are not very high. Open interest there, it's not very high. So if you take only say current expiry, and if you take say current expiry plus next expiry, the max pain values may not change actually. So there won't be any drastic differences due to lower volumes in the further expiries. So different houses are there. You can compute it only with current expiry. You can also compute with say current expiry and next expiry. So in our website, we are using only the current expiry to compute the max pain values. So okay, in the interest of time, I'll take you through the features. Uh, Yeah. So you can click on this link, Nifty Bank Nifty Tools, and you have different, say, tools listed here on the website. So I'll take you through the the charts first, and then explain how it can be used in the website. The first one is straddle strangle returns table. This is for Bank Nifty. So I've taken a screenshot of the particular table from the previous days. So what you see here is the calls basically. So you have 30,400 call, 30,500 call, 30,600 call, and so on. And what you have here is the puts basically 30,400 put, 30,300 put, and so on. So this table basically shows the returns of straddle and strangle basically. So if you sell both 30,400 call and 30,400 put, the expected returns is 12.8 percentage basically. So this is the straddle formation. This is similar to an inverted V shape basically, a triangle. So straddle returns, and this is very risky because the protection available for both the call side and the put side may be like say 200 300 points, and it's very risky to execute straddle say n days before expiry. On day of expiry, it's advised to trade straddles. So the table also shows the multiples of 500 in yellow color. So basically 31,000 say calls, 30,000 puts, 29,500 puts, all the entire row and column, they're highlighted in yellow color. So there's a general opinion that multiples of 500, especially in case of Bank Nifty, and 100 in case of Nifty, they form strong levels of support and resistance. So you consider this particular position, 30,600 CE and 29,900 PE. The current spot value is around 30,400 in this example. So this is 600 points for put, and maybe 300 points for call, and the returns here is 7.43. So if you want to take safer bets, you can go for this one, this particular combination, which is 31,100 call and 29,900 put. So here you have protection of at least 700 points on the call side, and you have 600 points protection on the put side. So there is total 15,500 point range in which you can play around with the Bank Nifty options. The table is updated on the website, and you have live values fetched from say the option data, and we are populating this in our website. So I'll take you through the site after a few slides. And similarly, we are using standard deviations of the previous 30 days. So why 30 days? It's a standard that is being used across the industry. You can use higher values like 60 days, you can use 90 days, you can use 1 week, and so on. So we prefer using 30 days standard deviation values. And if you use a shorter deviation, it will be skewed to the recent data. If you use a longer duration, the standard deviation values will get smoothened out, and you won't find the actual numbers. So here you have n days basically, which is 1 day, 2 day, 3 day, and so on till 10 days. And here you have standard deviation values, which is zero point 0.5 standard deviation, 1 standard deviation, and so on till 3.5 standard deviation. So this chart was generated on 28th March, and what it means is in 3 days, Bank Nifty is more likely to play around to be within the range 29,746 to 31,474. So two standard deviations corresponds to maybe around 87 percentage. So what it means is, with 87 percentage confidence, you can play around this position, assuming Bank Nifty will stay within 29,746 to 31,474. So if you go for higher standard deviations, the range will be higher. Say this is around 98, 99 percentage confidence. So 29,329 and 31,922. So what you can do is you can basically short 29,300 puts and you can short 32,000 calls basically. And there are two rows which are highlighted in blues. So this represents the expiry dates. So maybe 28th March, this represents 4th April, and this represents 11th April. So we are skipping weekends and public holidays, I mean holidays and NSE holidays in this chart basically. So when you say fifth, 5 days, it represents, for this particular chart, 5 days represents 4th April expiry, and this represents 11th April expiry. So I'll pause here to take questions. So Shubodh, you had pinged how to adjust positions when the price slide out of strangle. So we won't be covering this in this workshop because this is basically to show the different tools, and we'll definitely cover the adjustment say in later workshops, Shubodh. With the charts on your site, I would like to know the frequency and speed at which charts are updated. No, so we are using a refresh of close to 15 to 30 seconds. So we have bought data and we are using live data to publish these tables. So how to find standard deviation from the table? Standard deviation will be computed using historical data, and that is not part of this workshop actually. Okay, so I'll move on to the next tool that we have, so which is option chain analyzer. So I'm sure a lot of you have seen this chart and have been using it. So here we have the spot value. This data was, this is snapshot of March 8th. What do you call, end of day. So the spot value was around 27,762. The max pain on that corresponding date is 27,700, and PCR was around 1.16. So different columns, and the column names are very intuitive. So this is change in OI, delta OI, change in price, symbolic representation showing whether change is positive or negative, the total volume and the net OI here, and change in OI basically from the previous day. So today's OI minus previous OI. So this is a particular value. Then change in price from the previous day and last traded price, and you have the strike price. So all multiples of 500 are shown in red color. The PCR value, the strike price closer to the max pain is actually highlighted in red, and the strike price closer to the spot, current spot, is actually shown in blue. You can see that all multiples of 500, they have very strong support and resistance. In this case, 21,000 puts, you have more than 5 lakh quantity. Here you have 5.49 lakh quantity. 27,600, you have 3,28,400 quantity. So you can see strong supports here. And in case of puts, you can see huge quantity across, say, 28,000 and 28,500. Also, you have 2.62 lakh, and there are other levels with high, what do you call, open interest. So with some confidence, you can say that Bank Nifty will more likely play around 27,000, which is the max put OI, and here the least level, third important level, which is 4.92 lakhs. So you can safely short options here basically. So 28,400 calls, and here 26,900 puts basically. So to execute short strangles. So depending on whether the change in OI is positive or negative, you have these interpretations, which is short covering, long build up, say long liquidation, and strong. So we have explained this in the blog post on the website. So I'll go to the tools now. So I'll just pause to take questions. So Nitesh Pathak, you have been asking this question, annual return if you enter at SG2. So we haven't back tested this. It's up to you. We don't have live prices. I mean, 1 minute prices across what do you call standard 1 minute. We don't have 1 minute prices to compute this, so sorry, we don't have a number for this. Okay, so yeah, so you're curious to know the adjusted return. So the answer is we don't have it right now. So as the link is, so Ram has actually posted a link here. Yeah, sure. So I'll go through the demo now. So we have Bank Nifty straddle and strangle returns table. So you have a blog post explaining how to use this table, but I'll take you through the tool basically. So let's say 3 standard deviations or 2.5 standard deviations is 600 point on the put side, and for call it is around maybe 500. So I'm just giving numbers from the historical data, and what we are expecting. Let's say we are expecting at least 0.5% returns from this particular combination. So when you click on calculate, so you get a table highlighting those combinations which give at least 0.5% returns on the invested capital, and which are at least 600 points away on the put side and 500 points on the call side. So if you see the current spot value is at 29,938. So if you take 600 points on the left side, which is the put side, which is the protection for PE leg, the value is 29,300. So this is 29,300 put, 29,200 put, and so on. And you take 500 point protection for the CE leg, and which is basically 30,400, which is 30,500. So you take 30,500 and so on. So this is the combination. So you can put higher values to maybe, let's say, be more accurate, maybe 800 values for the put protection, 800 values for the C leg, and expecting at least 0.5% returns on invested capital. When you click on this, there is only one combination, which is 30,800 call and 29,100 put. So this table is live and it will be refreshed constantly. And we are trying to increase the say refresh rate, but there can be smaller differences in say the LTP that we have taken and the LTP that is actually live now. So you can use this as a reference for writing options, especially strangles, both call and put option written at the same time basically. So this is one of the tool that we have designed, and the second one is single leg option selling. So this is one-sided option selling, and it doesn't have the other one. Like say if you're writing put, you won't write a call basically. So when the markets were moving up for maybe 1,000 2,000 points, I was selling only put options to benefit from the rally basically. So in that case, what you can do is you can have a safe limit of maybe 500 points for the put options, maybe say again 800 points for the call options just in case. And let's say you're expecting a returns of 0.5 percentage on the put leg and maybe 0.75 percentage on the call leg. And this expiry is 18th April. When you click on calculate, you get their orderant values, is it? Yeah, so it shows that there aren't any option from the call side, and on the put side, you have these what do you call strike prices: 29,000 put, 29,100 put, 29,200 put, and so on. And the difference between the particular strike price and the spot value is strike delta, which is 939 points, 839 points, and so on. And the last traded price of the options is 14 rupees, 16 rupees, and so on, and the percentage return is 0.56, 0.64, and so on. Let's try a smaller range for the call options. I mean, you might have yeah. So if I take the range as 500 points for the put option and 400 points for the call option, the P return here is 0.5 percentage. The C return here is points on. If you take the values at 0.5 and 0.1 percentage, this is the table. So there was a connection issue here. So I hope like you can see the screen. So I'll pause for maybe 20-30 seconds just to check if you can see my screen. Okay, fine. So I'll take you through the particular what do you call tool. Yeah. So this tool basically gives the option chain analyzer that you see here. So I post static screenshots of this particular table at the end of daily basis, and you can see here live. So when you choose a particular expiry and click calculate, it gives the same table. You can see multiples of 500 highlighted in yellow. You can see the top three open interest strike prices here. So 30,000, 30,200. And on the put side, you see 29,700 put, 29,800 put, and 30,000 put. And the max pain is actually highlighted in red here, which is 30,000. And the strike, which is closest to the current spot, which is 29,938, it's highlighted in red, in blue basically. So you can see that the blue box and the red box, they are next to each other. And if you see this value like changing very drastically, you know that markets are going to move in a particular direction. It's going to trend in the next maybe like say 30 minutes, 15 minutes. And all these levels OI have exhibit strong support and resistance. So you can comfortably write options, say, which are beyond this particular say strike price. So in that case, 29,600 puts and 30,600 calls trading at 19 rupees, and say here trading at 65 rupees, or you can go further down. 29,500 is a safe resistance zone. 29,400 say puts, and then 30,600 calls here. So yeah. So yeah, a few of you asked questions on the group or on the performance. So I have been trading only short strangle and short straddles, and have started off with the say I started this on 1st October just to check the performance, and I started with 10L, and I made a profit of close to 5.82 lakh in 6 months, which is 26 weeks, at closing of say March 31st, and the annualized return is around 102 percentage. And I have won several Zerodha challenges in the past, and I'm like enrolling for further challenges to win Zerodha. So those who are using Zerodha, so I would urge you to basically take up this challenge, because it will definitely push you to say perform well. And so the certificate means a lot actually. Like you will actually feel happy when you get this certificate. So I have been using only short strangle and short straddle, and I use hedges in case of say market moves in a particular direction, which is trending direction. So this is my performance so far, and we have also posted regarding this on our website. So you can go through and check. If in case you have any queries, you can ping me. Performance since 1st October. Yeah. So I listed the weekly percentage and weekly profits, and so on. Yeah. So yeah, moving on. So yeah, we have listed a very what do you call? So we have covered the basics of options, payoff diagrams. We have covered put call ratio, open interest, max regions of open interest. We have covered uh, and a few aspects. So that is a brilliant idea that you get from this workshop, and from the different tools that you have designed. So the more important, I mean, there is another thing which is very important, which is the execution bit. So even if you have a very brilliant idea, if the execution is poor, you won't be able to crack, say, the alpha that you are seeking from markets, basically. So a brilliant idea doesn't mean an awesome returns from the market, but it's actually brilliant execution that matters more than the idea, basically. So we have built these tools to basically help, say, traders enable while say writing options. So what matters more is the execution bit. So and that will be covered in the next workshop. So I'll take you through the payoff diagrams in depth and say explaining around the point of maximum profit, how to identify break-even points in a given option portfolio. So I'll help you to unlearn and relearn straddle and strangle using 9 standard mathematics, which is basic analytical geometry. So I'll help you to build your own spreadsheet-based tools that you can use and you can compute. You can build complex strategies around say options. So we'll have a particular plan. So you'll be part of a Slack group or WhatsApp group where we'll be discussing trades. So I won't give any tips or I won't give any calls. So I'll help you to learn options and you should trade your own plan basically. And I'll share the strategies that I'm using for hedging positions. And with a defined risk, how to maximize the expected profit is something that I would take in the next workshop. And also how to balance option portfolio with live examples in case the market moves drastically in one direction. So all those will be explained in the next online workshop. And the next workshop will be a paid one, and we'll let you know the details, final details. So one of the prerequisites of this workshop is that you should have margin of close to margin to sell close to 6 to 8 lots of Nifty or Bank Nifty. So I prefer using Bank Nifty, but because I'm so used to selling Bank Nifty options, weekly options. So if in case you have Zerodha, you need to have close to 3 to 4 lakh rupees. In case of other brokers, you can choose accordingly the margin details. And you need to know the basics of say option payoff and other say in case if you know Greeks, it's well and good, but option payoff diagram basics is a must for the next workshop. So at this point, I'd like to thank my brother, Dr. Ramnath, who has been helpful in the tech part of the website. He has given a lot of advice on, say, hedging strategies and more from a very statistical view. I'd also like to thank my friends from TVS School Madurai, CEG, Chennai, and IIM Ahmedabad, and Zerodha, Nitin Kamath, and his extensive varsity module. There are several WhatsApp groups where I have say advise people have advised me. Thanks to all those guys, and we have a Slack group called Social Traders. Thank you so much. I used extensively investopedia.com, Stack Overflow forums for R and Python coding. So thanks to them. So in case you have any questions, please post them on the forum on the website, and the WhatsApp group that we have created for this workshop. You can post them the questions on the WhatsApp group too. So you can follow me on Twitter and LinkedIn and other WhatsApp groups. So I think we have hit the time. So it's around 3:50, and I'll stop here to take any questions from you guys. Once again, thank you so much for joining this online workshop today. So as I said, focus on one or few strategies and master in that strategy and execute only 1 or 2 trades per week and try earning a passive income. Yeah, all the best and thank you so much. So we'll take questions for the next 10 minutes actually. So I'll wait for you guys to post questions on the WhatsApp group, and from the next workshop onwards, we'll try to enable you to chat on the window itself so that it will be better instead of the WhatsApp group. So any questions? We'll take this till 4 p.m. And thank you so much for joining this session. So yes, Devendra, we don't have the standard deviations table right now, but we'll definitely try building this for at least Bank Nifty, maybe in a week's time. So we'll definitely work on this. Okay, Ranjit, you had posted some question around watching the market and holding this one. So what you can do is you can basically sell option and you can buy a hedge which is maybe 0.5 standard deviation away from the particular point. So in this case, let's say this particular case, you are planning to sell 28,500 or say 28,300 put call option here, 16.30. You can buy a hedge at 28,500 strike price, which is at 6.95. So the difference in premium, which is around 16.3 minus 6.95, let's take it as 10 rupees. So you will gain 10 rupees at maximum, and you lose 200 points, which is the worst case if market goes against you, basically. So if you have a hedge, you need not track the markets actively. But if you don't have a hedge, you should definitely sit before the computer, because markets can go up or down drastically anytime. So anything can happen. You might have a surgical strike or some news like demonetization, or some border related stuff, or anything can happen. So it's good to actually have a hedge if you're not sitting actively before the screen. So Kiran, yeah, so we are working on it. Spot movement versus Max Pain. So we have downloaded a lot of data, and I'll show you how Max Pain and the spot prices have moved, say over the day, basically. So I'll definitely make a video around this, and I'll post it on the website. So Manish, yeah, so we are planning the contents for the next workshop. It depends on, say, the knowledge levels of the different people who are interested. So few guys might be knowing the basics of option writing. Few guys may not know Greeks. So depending on like the audience, we would plan to structure the workshop. So we'll definitely keep you posted regarding the next workshop and the other details. Sure, sure, Subodh. We'll definitely keep this workshop for longer duration. And if there is something that you would like to cover again, please let us know. I'll go through it. I'll take you through the particular tool or demo right now. Like if you feel that I have done something like in hurry, let me know. I'll definitely take you through the particular tool or particular page. No, Manish, there is a huge resistance in terms of, say, buying SEBI licenses and other certifications that prevent people from managing others' account or, say, portfolio. So, to answer you, we don't do those services right now. So, Shubodh, do you feel that we have skipped some part, or we have taken we have hurried up in a particular topic? If there is any, like, let me know. I'll definitely cover it right now. So, JSA Finance, I'm not sure what your question is. What do you mean by normal standard deviation levels at 1% returns? So, I'm not sure of the question. So, what do you mean? Can you explain it? Sure, Subodh. We will definitely cover this in the next workshop. Say basically balancing portfolios, adjusting using hedge, and even say choice of brokers. So there are different brokers today. Angel broking, there is one Alice Blue, Zerodha is there, Upstocks is there. So few brokers have certain advantages, particularly for option sellers. We'll definitely take you through all those points in the next workshop. Yeah, so Manish, to answer the question, it was in December end, and so markets moved in a whip, what do you call, in a what do you call, very range bound direction. So it moved 300 points up, and it moved 300 points down, and so on within a short span of time. So I couldn't basically. So I have defined my risk as 5%. So maximum I would lose is -5%, and I tried balancing my positions in the counter direction, but the markets reversed again, and I had I had to lose money basically. So that's the only place where I lost close to 57,000, I guess, December end May. So yeah, we are trying to incorporate the changes in our strategy, and I'll definitely take you through those in the next session. Yeah. So one of the learnings that I got from that particular incident is that we have to move to a different broker that provides an option to buy far out of money options. So I would not like to name the broker. So there are few brokers that allow you to say buy far out of money options, and certain brokers have open interest restrictions, and they won't allow you to buy for OTM. So I have moved to a new broker company. I mean, I moved all my portfolio to a new broker. Yeah, sure, Ashwini. We will try to organize a offline workshop. The only constraint is geography. I don't know, like where you guys are from. So I am assuming majority of them are from Bangalore because our Google Analytics shows that a lot of visitors from Bangalore. So I'm hoping that if we have a sizable, what do you call, number of participants interested, we'll definitely do offline sessions here in Bangalore, or else I can travel to cities too. So Kiran, it is both positional and intraday. So it's not just positional. So basically, I write options on Thursday end of day or Friday end of day, and I'll roll over positions till say Wednesday end of day, and I book profits. Whatever positions I have, I book profits. And on Thursdays, I'll use intraday strategies basically. So I'll cover both positional and intraday strategies during the next workshop. Sure, we will cover implied volatility in options writing, and we'll explain the hedge for strangles too when there's a directional move in the next workshop. So we'll definitely take you through this in the next workshop. So Ranjit, honestly, I am not an expert in stocks. So I prefer index before because of the volumes and liquidity. So I tried selling stock options, and there weren't buyers or sellers at times, and it caused huge issues. So I am apprehensive of say thinking of selling stock options basically. So I don't deal with stock options. Okay, fine. If you don't have any more questions, let's close it here. Thank you so much. Thank you so much for participating in today's workshop. So once again, Happy New Year. So today's an auspicious day, and all the best. Thank you.